The U.S. just dodged a bullet. Congress and President Joe Biden have come to an agreement to raise the debt ceiling, avoiding a potential debt default. For more than a century, the U.S. has had a law that caps the amount of money the government can borrow. Prior to the new agreement, that cap was $31.4 trillion. The government hit this cap in recent months. Because the U.S. government spends more than it collects in tax revenue, its debts are constantly growing. Had there been no deal on the debt ceiling, the U.S. would have hit the limit and been forced to either default on some of its debt or stop spending on the many things the U.S. government spends money on, such as Social Security or the military. Either way, it would have been a major disaster. The new deal between Congress and Biden limits spending increases to 1% per year through 2025, except for military spending. That's below the rate of inflation and below the rate of which the U.S.'s tax revenues grow every year. So disaster averted, right? Not really. First of all, the debt ceiling is kind of a legislative fiction. For more than 100 years, Congress and the president have raised the debt ceiling time and time again. Since the debt ceiling was created in 1917, the U.S. Congress has raised it more than 90 times. It has never been reduced. With the U.S. debt sitting at the current limit of $31.4 trillion, the amount of debt owed per person in the United States is $95,000. But of course, not everyone in a country pays taxes. On a per-taxpayer basis, the debt is $198,000. That means to pay off its debt, every single taxpayer in the country would have to come up with $198,000. That's an insane level of debt, and debt ceiling or not, it will have serious consequences. The basic problem with constantly running up more and more debt is that it becomes harder and harder to find people to lend you the money you need. In a free market, when a government runs up more and more debt, it has to pay higher and higher interest rates in order to convince more people to lend it money. If the U.S. had a real free market for its government debt, its interest rates would have soared a long time ago. That would have limited the amount of money the U.S. could borrow. In effect, it would have been a real debt ceiling, one the U.S. wouldn't be able to raise. But in recent decades, the U.S. has come up with a way to avoid this. The U.S. Federal Reserve, the issuer of the dollar, creates new money out of thin air. It then takes that money and buys debt out of the market. U.S. debt is traded in the form of bonds. The Fed takes its newly created money and buys bonds with it, thus taking that debt out of the bond market. This reduces the supply of government bonds in the bond market, and so interest rates on U.S. debt stay low. Even though the government is borrowing more and more, the amount of debt in the bond markets doesn't grow, so interest rates don't rise. This trick is called quantitative easing, and the U.S. Federal Reserve started doing it in 2008 during the Great Financial Crisis, when the government borrowed enormous amounts of money to bail out failing financial institutions. The Fed did even more of this during the COVID pandemic, when the government spent like crazy to cover the economic damage of COVID lockdowns. But quantitative easing doesn't just keep the government's borrowing costs low, it also floods the economy with new cash. After all, every bond the Fed buys out of the market represents newly printed cash in the hands of the people, or usually banks, that hold those bonds. In order to keep its borrowing costs low and keep borrowing money, the U.S. has flooded the world with new U.S. dollars, trillions and trillions of them over the past 15 years. And as most economists will tell you, when you flood an economy with new money, this leads to inflation. Time and time again throughout history, governments have tried to print their way out of financial trouble, and time again it has caused runaway inflation. Check out our recent videos on Argentina and Zimbabwe to see just how bad this can get. Of course, the U.S. is not suffering from the kind of hyperinflation that hit Argentina or Zimbabwe, and that's because the U.S. is the world's largest economy, and the U.S. dollar is the global reserve currency. It's used by countries all over the world for trade, even if that trade has nothing to do with the U.S. dollar. That means there's an enormous amount of demand for the U.S. dollar and an enormous amount of faith that the U.S. will continue to pay off its debts and that the dollar will continue to have value. But even among wealthy, powerful countries, there's a limit to how much money you can print. Take, for example, the Weimar Republic of Germany after World War I. Prior to World War I, Germany was one of the richest nations on earth and the most powerful in Europe. When Germany lost the war, it was saddled with huge reparations for the costs of the war, and to cover those reparations, its central bank printed gigantic amounts of money. Eventually, there were so many German marks in circulation that global currency traders and the German population began to lose faith in the value of the German mark. They began demanding more and more money for the same goods. Inflation soared, and pretty soon you had to take a wheelbarrow full of nearly worthless money down to the local supermarket just to buy food for dinner. There are famous stories of people burning their cash in their ovens to stay warm because it was cheaper than paying for coal. Centuries before that, the same thing happened in the Roman Empire. As the Romans grew their empire, it became more and more costly to manage it. In order to afford the cost of maintaining this giant empire that spanned Europe and large chunks of Asia and North Africa, the Romans began to dilute their silver coins with cheaper metals. At the time of Augustus Caesar, the amount of silver in Roman coins was nearly 100%. By the time of Claudius II in the 3rd century AD, it had fallen to just 1 or 2%. And what happened? Inflation. The economy was racked by soaring prices in the years and decades during which the Roman Empire declined. Over the centuries, many of the world's dominant powers went through this exact process of printing money or creating new coins out of nowhere before the world lost faith in their scam and their empire collapsed. The US is nothing special, it's just next in line. People today think of inflation as something that's always around. Either inflation is low, like it was in recent decades when it ran at around 1 to 3%, or it's high, like it has been over the past few years, running at maybe 8 or 10%. But in fact, inflation is not the norm. Here's something you likely don't know. For most of U.S. history, the country experienced zero net inflation. There were periods of inflation, but they were followed by periods of deflation, so that the value of the money always returned roughly to where it was before. In those days, it was possible to stash money under your mattress, and that would have been a good enough way to save. Your money would have been worth more or less the same across years and even decades. But today, you have to take risks with your savings, putting it into stock markets or other investments, otherwise your savings will lose value. And how many people who just wanted to save for retirement ended up getting wiped out in stock market crashes? It happens again and again. Look at this chart. It shows how much money you need to have in order to have the equivalent of $100 in the year 1700. Note how for centuries there's almost no change. $100 in 1900 is basically the same as $100 in 1700. But then, starting in the mid-20th century, the amount of money you need to have the equivalent of 100 18th century dollars explodes. This is our current era of inflation. Why did this happen? Because up until the point inflation soared, the US had always paid off its debts, and US government debt was not constantly growing. Many times in US history, the government printed money in times of crisis. For instance, during the American Revolution, the US created a new currency called the Continental Dollar. It was backed by nothing. It was just pieces of paper the new independent US government printed in order to buy weapons for the war and food for soldiers. People saw right through the scam and its value kept falling. In other words, there was inflation, and the inflation was so bad that eventually the expression "not worth a continental" entered the US lexicon, and that expression was used for decades. But when the Revolutionary War ended, so did the printing of continental dollars, and the new US dollar was pegged to the value of gold. Because the government couldn't conjure gold out of thin air, it couldn't print money either. It could print only as much money as there was gold it could buy. So what happened? Inflation stopped, and in fact it went in the other direction, and there was deflation. Eventually prices returned to the same levels they were at before the Revolution. This pattern repeated again during the Civil War and World War I. The US printed money and there was inflation. Then the US stopped printing money and prices returned to where they were. Note how on this chart throughout US history there are periods of inflation, shown by the upward blue spikes, and then periods of deflation, shown by the downward red spikes. Prices went up and prices went down. But since the middle of the 20th century, there have been no red spikes downward, no deflation, only inflation. Prices only rise and rise and rise. That's because the US has just kept on taking on more and more debt. With the exception of a few years in the 1990s, the US debt has grown every single year for more than 70 years. In 1971, an enormous change happened without most people noticing or understanding its significance. President Richard Nixon unpegged the dollar from gold. Until that time, a US dollar was in effect a promise to pay the bearer a certain amount of gold. But since 1971, it has been backed by nothing but the word of the Federal Reserve. Trust us, this piece of paper is worth something. For the past 50 years, that worked, simply because of the amount of faith that the world has in the US economy and the US dollar. But those days are coming to an end, with trillions in new dollars printed over the last 15 years, and the US debt growing to ridiculous levels. It's becoming harder and harder to maintain faith in the US. The signs of this are everywhere. For one thing, numerous countries are moving away from using the US dollar for trade. Two of the world's largest trading countries, China and Brazil, recently reached agreements to use their own currencies for trade between them. That's $150 billion of annual trade that will no longer take place in US dollars. China recently announced it had completed its first purchase of liquefied natural gas in Chinese yuan instead of dollars. That purchase was from French energy giant Total. Among Among the U.S.'s Western allies, France seems to be the most worried about America's prospects. After a 3-day trip to China this spring, French President Emmanuel Macron called on Europe to reduce its dependence on the U.S. dollar. Around the same time that happened, India and Malaysia announced a new trade deal that will see the two countries use the Indian rupee for trade between them, instead of the dollar. Everywhere you look in the world today, countries are quietly moving away from the U.S. dollar, and something else is happening too. All over the world, central banks are scrambling to buy gold. In 2022, central banks bought a record 1,136 tons of gold, the largest amount ever. That's on top of massive purchases of gold in the previous 5 years, and so far in 2023, they're on track to break that record again. Why would central banks be buying gold? Their job is to issue currency, not invest in gold. The only reasonable explanation is that they see the end game coming. Many countries have followed the U.S. in printing large amounts of money. The European Union, Japan, Canada, Australia, they've all taken a page out of the U.S.'s book and have been printing money, especially since the pandemic. Now they're beginning to realize that someday, maybe someday soon, people are going to lose faith in a currency that's backed by nothing and is constantly being conjured out of thin air. They would never admit it publicly because of the panic it could cause, but the world's central banks are preparing for a day when they have to scrap the world's existing currencies and replace them with currencies that are actually backed by something real. But that will only happen after a massive loss of faith in the existing currencies. In other words, first, we'll have to suffer through a brutal period of inflation, and when the world's economies emerge on the other side of that inflation crisis with new gold-backed currencies, we'll be living in a world of limitations. Given what we've been used to our whole lives, we will likely be shocked at those limitations. Governments will no longer be able to take on as much debt as they want to, because there will be only so much money out there, and the more they borrow, the more they will push up interest rates. It will happen from time to time that a government simply runs out of money and has to default on its debt. Inflation will be gone, but deflation might happen instead. The prices of goods will fall, but so will your wages. It will be a harsher new world where economic growth is tougher and less certain, but it will be a world based in reality. And in the long run, that's a good thing. If you like this video, hit the like button. It helps us spread the word about our channel. And don't forget to subscribe to get notifications on our latest economic news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.